So when a homeowner dies and you have a trust or you have no trust, the moment the owner dies, automatically there's other people that have interest in that property. We need to take a few steps to make sure that those beneficiaries get their interest, but theoretically their interest started when the owner died, right? So when an owner dies and there's a trust, let's say, and they've identified beneficiaries, there's a change in ownership the moment that owner died, right? Fast forward, the house sells, all that kind of stuff. The time it took from when the owner died to when the property sold, let's say 6 months go by, the change of ownership happened and property taxes were reevaluated for that time, 6 months. At the time of sale during escrow, property taxes are prorated as to the owner's assessed value. So if the owner bought in the 80s and their assessed value is based off $200,000, but when they died, that same property is worth 800, that difference in property taxes, that's the supplement.
So it's what's still technically owed.
So there,
So in that case, it'd be the 600,000.
for the number of months that, if you divide it by a year, the number of months that the property was still held by the trust before it sold, then that's how much you should expect to pay. So we always advise our clients, hey, look out for this, hold back a reserve of X amount because you're going to get a bill at some point, right? And it's harder to ask beneficiaries to give money back to you once you've given it to them, right?